An improved inflation outlook and higher prices on products such as Tide led Procter & Gamble to a better-than-expected fiscal fourth quarter, though the consumer goods business gave a fiscal 2024 outlook short of Wall Street's expectations. Sales and profit grew in all of the company's segments in the quarter, and the shares right now are trading higher. Yahoo Finance's executive editor Brian Sozzi spoke with P&G CEO Jon Moeller on how he sees these results.
Very strong. 8% organic sales growth, every category growing, 5 of the categories, so half of our portfolio growing double digits, 7 out of 10 categories building share. If you look at it on a geographic basis, same general story, every region growing. The U.S., our largest market, we grew 6%, value share up 20 basis points, volume share up 50 basis points. And importantly, volume, which is going to be an increasingly important component of top line, is coming around. Take the U.S., for example, last 4 quarters, -3, -3, 0, +3 in the quarter we just completed. Strong earnings growth, 13% core earnings per share growth, 22% excluding currency. That all sets us up very well from a momentum standpoint as we head into our next fiscal year, which started 29 days ago.
Talk to us about the volume declines in some of the businesses. Are you seeing a softening U.S. shopper?
No. If you look on a global aggregate basis in the quarter we just completed, volume was -1. So very, very modest decline, which you would expect with the level of pricing that we've been taking. And as I mentioned, in the U.S., our largest market, volume +3. So consumer remains strong. They continue to value brands that are known and trusted, that perform in categories where we focus our portfolio, where performance drives brand choice. So it's been a good kind of ratifying experience overall in terms of the strategy that we've been executing to build superiority of our brands, product, package, communication, go-to-market, and value. And that's being reflected in consumer behavior.
P&G has been in the enviable position, Jon, of having relatively smaller exposure to private label brands. I believe a stat from Evercore pegged it at about 18% of your portfolio leverage to or just competes with private label. But within that 18%, in that number, I mean, do you see consumers trading down to private label?
There are some consumers who are, but again, we're building share, so that dynamic isn't pronounced by any stretch of the imagination. And we've given them an easier trade down path if they choose it within our portfolio. As we've extended the brands, take Tide, for example, now with the offering of Tide Simply, which we didn't have in the last kind of economic turndown. So they can, if they need to trade down, they can do it within our brands and maintain a very high performance level. There's some trade down to private label, but I think if you look over the last 3 years, we're talking small basis point increases in share while we've been simultaneously building share.
One number that jumps off this page, and we haven't been able to talk about this in some time, maybe 2 years, lower commodities cost, Jon. Wow. Within your next guidance, you've built in $400 million in savings. I almost didn't think the day would ever come. Where are you seeing the biggest declines commodity-wise?
In the petro complex and in pulp are the primary areas. It's not all one way. There are commodities that continue to increase. Obviously, we're dealing with other cost pools as well, where the markets are tight, like labor. And there's significant foreign exchange headwinds still, about the same number, about $400 million after tax as we head into next year. So it's not all a bed of roses, but it's a lot better looking than it was last year at this time. And our guidance reflects that.
Are you seeing, I think it was this week, Coca-Cola CEO James Quincey coined it intense inflation overseas. Are you seeing that overseas in your markets, and then the U.S. inflation picture starting to moderate?
Definitely, the U.S. picture is moderating some. There's still significant inflation in Europe, which may have been what James was referring to. And obviously, with a very unfortunate situation in the eastern part of that continent, there's continued pressure on pricing just from a supply standpoint.
In terms of pricing, P&G and a lot of other consumer products giants have been able to push through higher prices. the past 2 years to offset some of that inflation. But well, now that it's slowing down, what do you do with prices? Are you able to take them down? Do you want to take them down? I mean, how do you think about it?
Pricing has been a positive component of our top line growth for 49 out of the last 51 quarters. So it's part of our business model, which is driven by innovation. And to the extent that we can bring better, preferred, more delightful products and experiences to consumers, there's a modest amount of pricing that affords.
How would you grade the Chinese economy right now? Of course, you have exposure there through various segments. That economy, from the outside looking in, looks to have really slowed down. What are you seeing?
Well, versus 6 months ago, it's really picked up. Versus 4 or 5 years ago, it's a little bit slower. But we grew our business in China 4%. I expect that number to continue to increase modestly as we move on. But things are picking up.
Over the next 12 months, John, before I let you go, what products should investors most be excited about? We've talked repeatedly about increasing innovation at P&G. Do you have more breakthrough stuff coming?
We always do. I'm not going to talk about future innovation, but you and I were talking before we went on the air about our Dawn business, our hand dishwashing business, where we've had two major innovations, Dawn Power Wash and the Easy Squeeze bottle, the upside down bottle. And behind those innovations across the U.S. and Europe, we grew that business 17% last year. We built share 1.5 points in the U.S., 1.1 points, I think the number was, in Europe. So the team is constantly looking for ways to bring further delight to consumers. And I think those are two examples of doing that very well. That
brings up another good point. How does your team find some of these use cases? Because they ultimately help you to drive a higher price, higher sales, and better earnings. I didn't know I needed soap sprayed out of a bottle. I didn't know I needed a capless bottle. But to me, it makes a lot of sense. What is the origin story of these things?
The majority of it is just a proximity to and a deep understanding of consumers and their tension points. And once we understand those tension points, we try to solve them. So take the capless bottle. I don't know about you, but for years when I've washed dishes, it's kind of a messy experience, and the cap gets covered with the product over time, and no one likes that. So that's a tension point. And our team was able to identify a solution. It wasn't easy. That generally overcame that issue and made it even easier to wash by just simply taking the bottle and dispensing, as opposed to having to turn it upside down. So these are little things that make a difference. And when you can solve them and do it in a delightful way, good things happen.
And that was Jon Moeller, who is the P&G CEO.